Good morning, everyone. My name is Adam Dunnett. I'm the Secretary General of the European Union Chamber of Commerce in China, and we're a proud implementing partner of the EU SME Centre also since its very beginning, like the Italian Chamber. We now move to our first session, China's Economic Outlook. We have three fantastic speakers waiting to address you. Alicia Garcia-Herrero, Chief Economist for Asia Pacific of Natixis. Yes, she's very famous. Very pleased to have you here. We have Agatha Kratz, Director of Rhodium Group, also very famous. Great to have you here in person as well. And with our partner for many reports that we've done in the European Chamber as well, and a contributor to the EU SME Centre, François Chimits, Analyst for Mercator Institute for China Studies. Great to have you here as well. And with that, I'd like to invite the speakers one by one, starting with Alicia to present their keynote speech, and then one by one we'll do the address, and then all four of us will join on stage afterwards for a Q&A. So, Alicia.
Well, this is quite an amazing welcoming, and I'm a bit like, I should get out of here because I don't have many good news to give you. So I'm like, okay, I'm standing between the wonderful comments you get on how many businesses and how much we can do in China to what I think is going to be, to me, the reality on the ground. And that doesn't mean there are not opportunities. There are. It's just that we need to be aware of what are the constraints, not that they're not constraints in our market either. So I guess what I'm trying to say here is that it will be easier for us to make business in China fully aware of where things are heading, both economically, geopolitically, which I leave for Q&A, and also industrial policy-wise, which I have not covered, but I would be happy to, engage in a discussion of something called 10,000 Little Giants that might have an impact on SMEs in Europe. But that's not covered because I was not asked to talk about that, although I'm sure there will be some interest. And MERICS has a wonderful report on that, and we're finalizing ours as well. So, there's a lot out there on this topic. But let me go to what I wanted to cover here. I'm going to cover two things, but I'm going to try to offer some ideas along the way on SMEs, European SMEs. So the first is the short term. The second is the long term. On the short term, we have good news. Probably this is the best news throughout the presentation, which is China's third quarter GDP, which happened to be higher than expected, 4.9. And beyond that, I think for many SMEs in Europe, what really matters is retail sales, is consumption back. And there's something very interesting in the data. Think about automakers, European automakers. There's other problems there other than just the fact that vehicles, as you can see, finally are increasing at 8.4%. Until the third quarter GDP, I would say September, actually, retail sales, most of what you were seeing was services, consumption in services. There was hardly anything in consumer durables, and we're starting to see that. So this is positive. When I said there's other things happening, is that exports of auto parts from Europe into China are plummeting, minus 25% in the course of a year. So yes, you see that, but it's not for us for the moment. It might change, but it's certainly not what we see in European export data by sector. Next. So on the production side, I think something really positive, if you see on the left-hand side, sorry, I have lots of graphs, I hope you can bear with me, is that industrial profits are finally moving to positive territory. Believe it or not, China's industrial profits have been extremely negative throughout 2023, which is the opening year. So finally we see, and this is again very good news. And this is happening notwithstanding something I'll show you in a minute, which is that producer prices are still negative, which is something that was really pushing down profits. So we see some light at the end of the tunnel. I won't talk about PMI, slightly positive, but not really too much. Next, this is important for us, exports and imports, especially Chinese imports, which is what we export. So as you can see from that graph, I mean, we were already worried in 2022 that Chinese imports were growing at negative. They were in negative territory for a few months, but we thought it was the pandemic, and we said, okay, they'll be back and import our stuff. But as you can see in 2023, although there has been some improvement from a very negative territory, double-digit increase in Chinese imports. And I can only tell you, we have the European Chamber, Adam chairing, that if you look at volume, it's even worse. Volume of European exports into China in volume is really, really negative. And this is what worries me. Where are our exports? Because this is what matters for our SMEs. And here's the trade balance. China's trade balance, yes, exports are also growing negatively. But miraculously, in a way, you see that the trade balance is rather constant and very positive. To be frank, I can understand that because I'm going to show you in a minute the amount of outflows from China, capital outflows. If you didn't have that trade surplus, China would be losing reserves as we speak, as it happened in 2015. And let me tell you, it was $1 trillion then. So this trade surplus is cushioning the loss of reserves. China, in other words, needs a trade surplus. Next. Prices. So there was a time a few months ago where everybody was worried about deflation in China. You probably remember. It seems it got forgotten because we had a slightly positive data point. You can see there. I'm going to rush out. So here, 0.1%, which kind of stopped everybody talking about deflation in China. We're at 0 now. But I want to focus on producer prices. Because, producer prices are our prices. If I were an SME in Europe, I would check producer prices because that's what I'm competing against, isn't it? That determines export prices in China. And look what's happening. They're still in negative territory. That is worrisome if you think about deflationary pressures, but forget about that for a second. Think about competition. China is gaining competitiveness out of this. And if we move to the next slide, let me tell you that China is gaining competitiveness twice. Why? Because the exchange rate is depreciating even against the euro, against everybody. This is CFETS, which is basically an index of the RMB against everybody else. So you have the dollar, obviously very, very weak against the dollar, but even against the rest of the world, CFETS on blue here, you can see that the RMB has kept on depreciating since 2022. And this is the real effective exchange rate. Sorry, I'm an economist, you can tell from now, but this is basically the best measure I can think of competitiveness because you're taking into account inflation differentials. The more we are in this inflationary, thanks God it's improving, but I mean, in this inflationary mode, while China keeps 0 price increases, if not negative for export prices, the more competitiveness China is getting compared to us. So competition from China is becoming, we can see it in export markets, wild. Nothing wrong. This is, we believe in competition, but this is something that I need to show you. It's going to be very tough out there to compete with Chinese corporations in third markets, even in our single market. So one thing to realize that is not going so well. So I said consumption is back. I mean, not fully back, but better, not yet to 2019 levels. But fixed asset investment is not back. Actually, this is good for China, in my humble opinion, because we've been saying for a long time, China was investing too much. So yes, that's improving. But one thing to note is that a lot of that reduction in or very low growth in fixed asset investment is because of the real estate sector. That gray line there is fixed asset investment in real estate, still highly negative. Next. Now, what about us or the world investing in China. So maybe their fixed asset investment is not very strong, but they're getting a lot of money out of the rest of the world to produce in China. Well, not really. Not really. It used to be the case in 2021 massively. It's no longer the case. So inbound is growing at 0. Outbound is recovering slightly. But what I want you to focus on is capital outflows from China. So look at that violet line. We are getting close to the big outflows in 2015-16. And there are 2 reasons. First, interest rate differential. Yeah, I mean, it's just, this is not only China. We see outflows from EM generally, although China is the biggest. And also, of course, if you look at stock market performance in China, is basically the worst index that this year. And therefore, you can imagine that this is pulling capital out. But there's also unrecorded outflows. Yeah, I mean, this is not only about portfolio flows. This is about China, Chinese residents putting money outside, and that I think is a little bit more worrisome. On the real estate, notwithstanding the good news of the 3rd quarter, there's no improvement. Whether you prices or transactions, land transactions, this is very important because local governments rely on land sales. And as you can see, there is no improvement, just stabilization at very negative growth rates of land sales in China. So that's a little bit of a worry, in my view, that still remains lingering in the Chinese economy. Next. Can the PBOC save us all after what I said? Well, yes, they have room. I mean, interest rates are still high compared to where they went in the rest of the world during the pandemic, say. I mean, there's a long way to go. But can they do it if they have so many capital outflows? This is the thing. How much can they push interest rates down without having a very weak currency that they need to protect, as they are doing now? Fiscal-wise, I think the room is very limited. They have already 100% public debt and very large fiscal deficits. And I think you can tell from the leadership's approach to this issue that they are not ready. And I think it's right not to do big stimuli given their fiscal situation. Next. So structural deceleration. So this was like what we to expect this year. But the question is, if you're an SME and you're investing in China and you want to, I think you need a little bit more than that. You want to know where is China heading long run. And I'm going to argue here that China is going to decelerate structurally, but that there's nothing wrong in that. That any country with $10,000 per capita tends to decelerate. Because that's, the law of gravity, if I may say so. Next. Now, so if you follow that law of gravity and you make some calculations of labor productivity, you come up with a number. This would be any country, basically, that would head to 2.3% by 2035. So this is China by 2025. You're an SME, maybe some of you are. You are in China. You want to know what China will be in 10 years. Is that a big problem? Well, China by then will have 25,000. These are all, it can change. Yeah, this is just some estimates. $25,000 per capita, not bad. Nothing wrong with it in principle. The problem is, well, will it be bigger than the US? Not that I care because I don't believe in that competition, but the answer is no. And, somebody came with this idea, I think Goldman, that it would be 2030 something. Well, if it's not by 2035, it will never happen. Is it a big problem? Not really, not at all. But, many people ask that question. Next, the real issue is after 2035. Now, why is 2035 such an important benchmark? Well, first, Xi Jinping's own commitment to doubling income and fulfilling rejuvenation, etc. But not only that, it's because urbanization in China will be done by between 2030 and 2035. That's very important, believe it or not, because now the population is falling, but not in the cities, because the bulk of the fall is in the rural areas. Once they fully urbanize, the impact of aging will be full. And by then, you need to detract that loss of labor supply fully from the growth rate I showed you, which is going to be very similar to Japan. And that's where there will be divergence with the US. Well, anything could happen in the US. So this is just, assuming that nothing happens there, which is a big assumption. But just to say that, next slide, and I finish very quickly. Can this be smoothed out, or is there a way that we could keep higher growth in China? Yes, sure, innovation, and this is why China is pushing, and 10,000 Little Giants, many other projects. Innovation is the key. Now, how long has China been innovating? For quite some time. Is it already measurable in terms of productivity? No. Will it be? Maybe yes. Maybe yes. Maybe it takes a long time. China's already moving up the ladder. But the reality is that when you look at total factor productivity, it is really not growing yet. Why? Because beyond innovation, there's many other things, yeah? Rule of law, institutions, blah, blah, blah. There's many other things that need to happen, in my view, at the same time. Next and final, I believe. Yes. So here's the thing. I think, yes, China is an amazing market, no doubt about it. I tend to say that China is too big to be ignored. And we're not ignoring. I'm not trying to ignore China. I'm just saying that there are things that will certainly push China's growth down. Is it a big problem? No, depending on what you sell. Maybe, if you sell, I don't know, elderly care, or who knows, it's not a problem. And there may be other problems, but growth won't be a problem. But, if you're thinking of a very, very fast market, China will not be by 2035. You may need some other growth markets to compensate. It will be a huge market, but it will not be a growth market. And I would just say final thing on what it means now for us. What it means is that China needs to export. It desperately needs to export. So bear in mind that competition from China will be wild. And they have a very big instrument, which is competitiveness, meaning very cheap RMB and very low producer prices or export prices. So I would focus more on the competition at this moment, in the sense that we need to prepare as SMEs, whether we are operating in China or anywhere else, for this competition. And we need to really know well what China is doing industrial policy-wise, which I'm not going to cover, for SMEs, so that we have a sense of where the competition will be coming the most. That's all. Thank you.
Hi, everyone. I'm Agatha Kratz. I'm a director at the Rhodium group here. Hey, here you go. I'm very happy that we had this great introduction by Alicia, because she really set the scene for everything I'm going to say later on. In particular, I think Alicia will underline your point about trade opportunities, right? And the import versus export picture, which I really align with in my analysis. So I'm glad you set the scene here. My presentation is mostly about investment and the state of foreign direct investment into China. So it's lovely and complementary here. But this is a very important part of the question for SMEs. So diving into the investment picture, what does this all mean for foreign appetite into the Chinese market, foreign appetite for investing in China? And what does that mean in particular for SMEs? If we go to the first slide, if you don't mind, I want to set the scene a little bit before I speak about the latest development and the future, because I think the scene is an important one. And it's one that people don't necessarily get from the get-go. The picture for European but also US investment in China over the past decade has actually been one of dwindling foreign direct investment appetite. This on the slide is the numbers that we collect at the Rhodium Group on a transaction basis, meaning that we just scout for every single piece of public information that's available about foreign investment into China, and we put it all together into a mega spreadsheet that makes it into this slide. And what we observe over the past decade actually is that we've seen a secular trend of decreasing FDI, foreign direct investment from the part of the EU, from the part of the US into China. We've gone from the high of 2012, which you see very clearly on this slide here, of about 15 billion of yearly investment into China from a wide range of European and US companies, to what is now closer to 8 or 9 billion per year in 2022. The picture is actually going to look even smaller in 2023 from the numbers that we're looking at the moment. So you're going to see more of a decline again in 2023. So we're about 30-40% below the kind of early 2010 numbers, which was really the high of foreign direct investment to China. Not a big surprise. I mean, 10 years post WTO accession, there was extreme appetite into investing into the Chinese market, setting up manufacturing plants, setting up capacity there. A lot of companies by now are on the Chinese market, of course, but it's still surprising because we're facing declining investment compared to an economy that's been growing for the best part of the past 15 years, are above 5%, certainly at some point above 10% growth rates. And so we've seen FDI kind of decouple from the growth and the GDP growth picture, which just is here to show that there's actually been underwhelming and underperforming foreign direct investment into China. So that's part of the picture. It's an important one. When you look at single transactions, we've also seen that number decline actually even more so. So we used to register in our methodology, but I can speak to that a little bit in a minute, but our methodology just includes above 1 million investment, which of course has a number of caveats for people here speaking to the SME sector, because above 1 million is already quite a bit of an investment, but transactions above 1 million have come down from about 200 to 50 transactions per year back when we started counting to about 100 today. So we're seeing fewer investment in terms of volume, fewer investment in terms of value. And if we go to the next slide, we're also seeing quite an extreme concentration of investment around a few large transactions and a few large companies. So any given year of the past 3-4 years, about 80 to 85% of foreign direct investment into China from the part of the EU, but also from the part of the US, is pretty much 10 companies making a big ticket investment in China. The rest is fewer, smaller companies, but they're dwindling in terms of their importance in the overall picture. And that's a very important, very decisive trend here that has a lot to do with the place and the opportunities of and for SMEs on the Chinese market. And I'll get to that in a minute. I just want to underline a small caveat here about our methodology. Once again, we're counting things that are above 1 million. And so we might be missing a lot of what's happening below that threshold. And there might very well be a lot happening. And we expect and we know that there is a lot happening below the 1 million mark threshold. There's also to be noted the fact that SMEs are often present on the Chinese market through sales representation, which we don't capture, right? So there is a type of SME specific engagement in the Chinese market that we're not going to be capturing here in our numbers. Nevertheless, I think what we're seeing in terms of the dwindling appetite, but also the concentration around big companies, large companies in China, is quite telling of dwindling opportunities for SMEs in China for a number of reasons. The first one is the policy and regulatory burden that has continued to be strong and has kind of stifled some of the appetite for smaller companies investing and finding the barriers to accessing the market harder and harder. Politicization, of course, of policy making, which is increasing the risk compared to lower economic opportunities, which has heard Alicia speak about lower economic growth in China than, of course, 5 years ago. And so the rewards compared to the benefits, the costs are in a slightly different balance today than they were in the past. And of course, we're also speaking about just pure regulatory hurdles around data management, around procurement and things like this that are getting slightly harder. And that's also a picture that's really hard to navigate. Fortunately for SMEs, we've got excellent centers here to help, but sometimes it's not enough. And so you see a little bit more of a wait and see attitude on the part of SMEs. Not being able to travel to China for the past 3 years, of course, was an enormous hurdle. And so I'll speak a little bit about the forward-looking picture in a minute. Last but not least, and I think actually very, very important, Alicia, you started speaking about this. François, I expect you will speak about this, is competition. So China and the China environment today for SME is one of much higher, much stronger, much fiercer local competition across a very wide range of sectors. And so where it was much easier to enter the market, get good market share, but in the past, that's not the situation that we're facing anymore. So those are unfortunately slightly gloom comments, but that got off completely. Sorry about this. So forget the one on the left, and that is slightly off. That doesn't mean that there are not as well pockets of opportunity. And Alicia started to speak about this, and then François will speak about, in a 17, 18, 19 trillion economy, of course, there are numerous opportunities for companies to do business in parts of the economy that aren't linked to property and real estate and infrastructure. And that is something that needs to remain in everyone's mind. But top line is of dwindling and slightly complexifying picture for inbound investment into China for SMEs. I want to speak about just the latest numbers that we're seeing emerge from China. Once again, we're emerging in China from a state of zero COVID policy. We are emerging from 2022, which was a very complicated year for the economy, for companies on the ground. And so if we go to the next slide, I just want to show the very, very slight optimistic picture here, which is and I'll speak about this in a minute. But in short, after 4 quarters of continuous decline and very, very consistent decline in foreign direct investment, European foreign direct investment into China, we're finally seeing a little bit of an uptick, right? And this is COVID reopening. This is China's economy getting back on track. This is just mending the wounds from 2022 and going forward. And we're seeing a little bit more interest in terms of, and on the left is completed FDI transactions, on the right is announced FDI transactions. So the picture looks even better if you look on the right-hand side, because you see that companies are starting to re-announce investment into the Chinese market in much bigger numbers. So the key question now, and the key question for us, we'll be looking out in the next 2 quarters, but the key interrogation is that merely catching up from the COVID time and the COVID year of 2022? Had companies kind of postponed investment decision, and those are kind of all happening at the same time? Or are we really looking at a slightly more cyclical upturn with a little bit more interest here? There are reasons to think one or the other. One thing to note, if we go to the next slide, is that the general picture of concentration still stands. We still have large companies mostly present. We still have, especially German companies, dominating the picture. We're still seeing a concentration in terms of sectors. Auto and chemicals are still really the 2 biggest contributors to that trend. But nevertheless, there's a little bit more diversity on the horizon. We're seeing machinery, consumer goods, all of a sudden coming back to the top 5 with a little bit more excitement and opportunities there. We're seeing a few acquisitions as well that we just weren't seeing as much of in the past year. So there's something happening here. We're going to be tracking whether that is just a 1 quarter, 2 quarter rebound, or if it's a more cyclical trend that could take us a few years back. Now, at the end of the day, we're still way below levels in 2012, certainly way below levels in even 2019. And for the time being, and given China's policy mix, there's little expectation that we're going to get back to those 15 billion, even above 10 billion numbers that we had seen about a decade ago. I think with the trajectory of China's policy mix, with geopolitical risk rising, and with what I'm going to show you just in a minute, it's very unlikely we're going to get back to the sunny years of the early 2010. Just one last word to conclude. If we go to the next slide, one trend that I do want to underline here as well is something we're picking up in the data very clearly, and that is a movement of diversification away from China on the part of MNCs that used to be very much focusing their high growth market efforts on China for a long time and are now scouting for opportunities around. We see that in a number of data points. We see that in, of course, business surveys. And here, thank you to EU CCC colleagues who are doing such a fantastic job collecting that survey analysis, we're seeing companies saying again and again, or more and more, sorry, that they're not planning to increase investment into China. Fewer companies are planning to just make a bigger investment next year than they were last year. And that has a lot to do with the economic outlook, but also the policy outlook and the geopolitical outlook, all of this kind of gathering together and just bringing companies to rethink their next investment in China. That shouldn't be equal and shouldn't be thought to be decisions to divest. We're not speaking about companies moving, packing their bags and getting out of China. We're speaking about companies that at the board level or at the strategic level, when they have to decide where to put their next euro or US dollar of capex, are going to go to another destination rather than China for their next investment, right? So it doesn't necessarily mean shrinking the China footprint. It means now next, what do we do? Then maybe the next investment, we're going to consider Vietnam, we're going to consider Hungary, we're going to consider Mexico a little bit more than we did in the past, because all of those factors are compounding to make it harder to be in China, unless it's in China for China, by the way, where we're still seeing quite a bit of appetite. We're seeing that happen for investment. We're also seeing that happen for sourcing. So we have more and more companies saying that they're trying to find alternative suppliers for what they were sourcing so far from China. And there, what's interesting is it is partial. There's so much that's being produced in China, so much that's being sourced in China that you can't really just overhaul your supply chains all of a sudden. But at the margin, for 5 or 10% of sourcing, whenever a produce or an input is single sourced or is overly concentrated in China, given what we've learned from COVID and given what we've learned from Russia and Ukraine and the crisis on our borders, companies are starting to try and de-risk some of their supply chain, right, at the margin. And that is showing in the numbers as well. At the end of the day, what that means is that China's share of global greenfield investment is decreasing overall, and China is becoming less of a central destination for global greenfield investment by large companies, but also by SMEs. And we see that in the numbers. Very quickly, where do they go? If we go to the next slide, most of them go to Southeast Asia still, if you take the broad range of MNCs, and especially MNCs from Northeast Asia, but not just. So, of course, Vietnam, Thailand, Malaysia, India to a certain extent, but there's a little bit of discrepancy between the sectors here. Certainly Europe, when we're speaking about European MNCs, they're thinking, you know, should I add a production line in Shenzhen or should I add a production line in Poland? And they will go for Poland, right? Because they already have a factory there and they're thinking, if I'm going to spend, once again, my next euro of capex, maybe I just widen, maybe I just add a production capacity or a production line to something that already exists in Europe. So we see a lot of that. For US companies, Mexico is the same kind of thinking there. And you start seeing this in trade data as well, that especially for the US, China is now declining in terms of trade partner, and Mexico and Canada and other countries are picking up. So you really have a relocation and reshaping of globalization as we're speaking at the moment. Just one last slide to end on that. That doesn't mean China gets out of the picture at all, because for a lot of those relocation, for a lot of that new investment in India and new investment in Vietnam, you actually still need to source your inputs from somewhere. And that somewhere is going to be China for the most part. So it's really painful, hard, costly, long to move manufacturing from one country to the other. We're seeing that happen for final assembly. We're seeing that happen for certain manufacturing steps. But the whole of it is just so much harder to move. And so what was taking place in China for the most part is still taking place in China, which is single step being moved out. And that means that at the end of the day, you are both at the same time diversification very clearly happening, but the part of China remaining extremely strong in that globalization. And we're going to have that happen for the next decade and continue to happen very much so. So let me leave here. Maybe the last data point is an interesting one. China is going to remain part of global value chains. Chinese companies are going to remain part of Chinese value chains. We're actually seeing them as trailblazers of that diversification move. So MNCs are moving, Chinese companies are moving to Vietnam, they're moving to Mexico. And so they're also going to be a very, very big part of that picture. Let me pause here. Thank you for having me today. And I look forward to Q&A.
Hi, everyone. So after the general economic outlook and the more specific data and presentation related to investment, we're going to refocus a bit on the internal dynamics in China and especially the public policy angle. First slide, please. So as Alicia has already largely mentioned, we are facing a definitely growing slower China in the future that we've seen in the past. And actually, when we break down the composition of what makes growth, there is limited uptick prospect for Chinese growth to accelerate in the future. The first one is quite stating the obvious, as you all know, the demographics is not pointing into a growing direction. The last number are particularly striking in that regard, with a fertility rate of 1.1% that would put China on track for a population of 400 to 500 million people by the end of the century. Obviously, this is not the most likely forecast. 2022 was a specific year in China with zero COVID and everything. But still, I think it's important to emphasize that this is the trajectory of demography in China. And obviously, that is not a contributing factor to growth in the long term. When we look at the dynamic of actual extra labor, that was a major provider of capacity to produce in China over the past 2 decades, there is still only a 35% of urbanization rate in China that could and often lends itself to an identification of an extra pocket of growth for labor in China, when actually, when you look at the details of it, it's mostly elder population. 60 to 70% of that population of rural inhabitant in China are above 40, so less likely to move to urban area and actually provide the Chinese economy the similar input of cheap labor that we've seen in the past. On top of it, the other main input in an economy is capital. And in that regard, the level of debt to GDP ratio, or the level of debt in China, does not point as well to an increase of actual capital as an input to GDP. We have an economy in China, if we take the old economy, that has a debt to GDP ratio of more than 300%. And this is only overtaken by Japan when you look at advanced economy, which is at 400%. Just to put you the thing in perspective, the EU and the US is broadly around 250. What is particularly striking is that in China, we have reached that level in almost in 15 years, which has basically contributed massively to the growth we've seen in China over the past 15 years. And that number is condemned to be stalled in the future. Over the past now 3 years, or if we take the reference point as before COVID, China has accumulated 40% of GDP of growth of debt, when the US and the EU ratio has been broadly stable. So growth will no longer be coming from an increase of capital in the future. And the last element that helps you to generate growth in general is innovation or efficiency, if we take it from a macroeconomic perspective. And that is the number that Alicia has already shown. In economy, we have what we call total factor productivity to assess the overall efficiency of the economy. And what is here particularly worrying so far is that the majority, if not 100% of the past decade of China growth has happened without efficiency gain. And the direction of reform, to which we will come back at the end of this presentation, is not pointing to a much favorable outcome in the future. So I know Alicia has not touched upon that matter, but if you refer to the most conservative or the most authoritative estimate, which is the latest IMF report from last year regarding the perspective of Chinese growth, you indeed have a 2% growth by 2035 based on their extremely favorable hypothesis, I would say, which is likely a byproduct of the fact that the IMF is still a political institution, and it was likely constrained in providing lower forecasts for Chinese growth, but that would definitely set China on track to not catch up with the overall US GDP, which was not, and definitely not, the flavor of the discussion 2 or 3 years ago, especially in 2020, when advanced economy and most of the world were struggling with COVID, and China was definitely pushing strong when you had those expectations of having China overperforming the US before 2035 or 2030. Trying to bring a little more positive note here after those few presentations and those few slides, China still has massive growth potential. And we are well placed in Europe to know that if you do not have 5% or 3% growth, you can still have growth, and you can still have a developing society and environment nevertheless. China only is at a level of development which is 20% of GDP per capita compared to the US, roughly 30% of the EU. And if we compare it to other fast-growing East Asian economy, it's roughly at 50% of the development process that experience other regional economic success, such as Taiwan, Japan, or Korea. And indeed, when you look at more granularly, China has an awful lot of quite outstanding capacity. The first one is, I would say, impressive human capital. China still generates 12 million university graduate a year, 40% of which are from STEM degrees, which is something much higher than other advanced economy. Typically, the EU is at 25% of STEM graduates from its university. The US is at 20%. And those people are replacing a generation that has hardly been to university. So there is a natural benefit by the sheer substitution from an aging population that had gone through the difficult times of China back then with limited university degree to now a very dynamic human capital accumulation in China. One example, one illustration of the quality of that is that whichever metric you use, you find a very nice footprint of Chinese university in the top performing university worldwide. And I think it's quite important to remember that China does still generate extremely qualitative human capital that is definitely not reflected in its level of development when we measure it by GDP per capita. Obviously, and I think it goes without saying nowadays that in many sectors, you do see Chinese performing extremely well, having either catched up or having overtaken most advanced economies in that regard. And here we have obviously the renewable energy and related sectors. The one in Europe that we are most, I guess, aware of, unfortunately, is the electric vehicle performance of China, where China was still 3 years ago only exporting 1 million vehicles a year. Nowadays, it's around 4. In 2023, it should be around 4 million, actually bringing China to the top position of world exporter of car in volume, which was not a prediction that was the central scenario 4 or 5 years ago. And you have that being reproduced in many sectors, especially, obviously, so green related, as I mentioned. You can take batteries, you can take solar panel, obviously, but even if you extend to other sectors, e-commerce, drones, robotics, you see an extremely well-performing China. And often that sectoral performance is actually the result of a catch-up, and if not an overtaken of Chinese innovative capacity compared to the rest of the world. And as we have mentioned, this does not reflect the overall efficiency of the economy as measured by the total factor productivity growth, which creates a puzzle for us economists, because we have rarely seen in the past an economy that was capable of catching up so well in specific sector while failing at developing its overall macroeconomic efficiency. Potentially, as Alicia mentioned, there is maybe just a lag here. Potentially, there is just also a byproduct of a redirection of priority within China away from growth and towards securitization, which might explain why you have circumscribed, located, innovative performance that are not represented in the overall efficiency of the economy. 2 points that I think is important to emphasize regarding the capacity of China to still deliver in the future. First one, the Chinese state has massive capacity to act. If you look at its financial assets, its assets overall, it's quite striking when you compare it to advanced economies. The state has the capacity to do an awful lot of things. Those things can be bad, can be good, but I think it's important to emphasize. And Another dimension is that attached to those, I would say, financial capacity, the state has an awful lot of reform capacity. I'm not discussing here the quality of reform, but just the ability to implement changes in the economy. Most of the difficulties we are seeing at the moment in terms of economic performance in China is actually derived from an ambition of the state to thoroughly reform and reorient the economy to a point that in most advanced economy we are not familiar with. Just to give you one illustration, China has reduced the number of employees in the coal sector by more than 3 million in 5 years' time. And this has gone without a massive social unrest in that regard. And this is just one illustration of the many possible of the capacity of the state to run reform. Once again, capacity of running reform doesn't mean you're going to perform well, because you can actually run pretty bad reforms. But still, it's important to take that into account when you look at the capacity of China to move forward. Next slide, please. And still on the upside of things, which I thought it would be important to emphasize after what I had expected to be a more gloomy perspective from Alicia and Agatha, actually, a lot of interesting things are happening on the ground in China. And when you have this very gloomy discussion in Europe or in the US among economists where China is heading, sometime on the ground, you might not, or you might find conflicting realities compared to that discussion. And one thing is that indeed on the ground, China is leading a lot of pro-market reform if you take the reform in itself. And one striking example, I guess, in that regard is the support for innovative SMEs and the development of an environment of venture capital in China that is very dynamic. You have seen a much more market-oriented financial sector, more default, more interest rate volatility in the system, so better pricing, or at least more granular pricing of risk within the system, which is normally brings efficiency in terms of allocation. And that is part of a broader set of reform that Xi Jinping encapsulates as a development of socialist market economy. And that is the ambition to have market forces as an instrument between a very strong monitoring and incentive system developed by the party state. And I think we could come back to the specific discussion on specialized SMEs and little giants, but I think it's really capturing that idea of trying to harness market forces to steer it towards political objective as defined by the Communist Party. However, when you look on the ground, indeed, those specific reform, and you have had some also very interesting one on intellectual property, on competition regulation, are not the dominant factor of what we are witnessing. And what we are witnessing is in practice a state or an economy that is being more politicized, and what the Chinese often captures as a state advancing and the market or the private sector retreating. And you can find that in the actual investment numbers, but you can also find that if you look at all the PMIs, you systematically see large firms overperforming SMEs for the past 5 years, which was not the trend of the day a decade ago. And it's a way of, and I guess we can capture that, or we can assess that as a form of vote with their feet by investors, or vote by the wallet by investors. In an environment where politicization has become the flavor of the day, where excess accumulation of capital and income has been definitely pushed back by the leadership that has developed and unrolled a very strong Marxist-Leninist narrative in the past couple of years, investors are not willing to buy in the new system. And we are seeing that with domestic investors, and as Alicia pointed out, obviously also with foreign investors. Over the past 18 months, we have seen more than 300 billion USD of outflow from China, not quite a vote of confidence in the new development model that Xi Jinping is trying to unroll. And trying to end on a more positive note after those gloomy perspective, there is some orientation of reform that could help China to realize the growth potential I've mentioned in the second slide. And that is largely for us among economists quite consensual, and that is a rebalancing towards a consumption-driven economy. What is particularly surprising is that this is part of the reform that is officially being pursued by the CCP. Under the mantra, the concept of common prosperity, this is enshrined in the 5-year plan, this is enshrined in the Congress work report. You have this ambition to develop a consumption-driven economy at home. The problem is, when you look at the numbers on the ground, this is not happening. And this is another big, but maybe less of a puzzle, but at least inconsistency we see in the system that unfortunately seems to indicate that Beijing largely prioritized techno-innovation objective and objective of securitization of its economy over the development of that consumption-driven economy. And finally, just to really try to end up on a nice note regarding the forecast of the Chinese economy, even in the case of an extreme scenario of a Chinese economy that is not growing by 2035, so let's say the lower band of the IMF estimate that I mentioned previously, if China rebalances, you can have at the very same time a very growing Chinese market for retail producers, alongside a stalled Chinese economy. And just to give you an illustration here, we have made that forecast with that extreme scenario of 0% growth, and we have put the Chinese rebalancing on track with the Japanese rebalancing of the 1990s. And what you see is that if you focused on the big red line, which is Chinese consumption, you have at the very same time stalled GDP growth and a very dynamic consumption market. And as Alicia pointed out, most of European exporters to China, or at least a large chunk of European exporters to China, are mostly focused on the retail market and related sectors. And hence we could have potentially, if the reform are being finally implemented, alongside some gloomy perspective from a macroeconomic dimension, some very positive notes on the ground from SMEs and especially from European enterprises located in those sectors that could capture the benefit of the rebalancing of the Chinese economic model.
So Alicia, Agatha, thank you. I have to admit, François, you said you were surprised that the presentation from Alicia and Agatha were much less gloomy than you expected. I totally concur, and even your presentation was much less gloomy coming from MERICS than I expected. So I think we're off to a pretty good start with a very sort of objective opening remarks that we had from Renzo at the beginning that I also really appreciated, to the economic overview that we're seeing. I guess my first reaction, everyone's talking about China slowing down, but China growing at 5% in absolute terms is still more than we've ever seen before, compared to 10% that we were having 15 years ago, because it's 3 times the size of the economy, right? And the restructuring, I think that Agatha mentioned as well, of the economy in China, as very prevalent as it is, doesn't change the importance of China as well. So with that, I was really surprised by the comments on total factor of productivity. Anyone who's been to China is obviously amazed with the high-speed trains, the financial service payments, and just the incredible infrastructure. Can maybe one or the two of you, because you both mentioned it, elaborate a little bit further? How and why is it that total factor of productivity, is not being picked up, because everything else that we see in reality seems to be just the opposite? And maybe we need another definition or metric for measuring it.
Let's start. So first of all, on this idea that 5% is more than 10, I understand what you mean in terms of contribution. So if you look at the contribution to, not to global growth, which is less, but because, you know, other things are happening. Yeah, India is there. I mean, others are growing more than China. But the whole point here is the following. This is Japan, and we need to learn from what happened in Japan. No, yeah, but even in absolute terms. So first of all, when you do capex, you know better. You serve lots of European companies in China. When you do capex, it's not that you actually look at what you do is basically you increase your capex based on your existing capex. Yeah, you already knew how big the Chinese economy was last year. What matters is growth for you. Yeah, because that's why you're so 2023 was, and this is Goldman, famous Goldman, saying 8%. Why? Because 2021 was 8% because they were coming from COVID. So 5%, sorry to say, is low. We can dress it up, but 5% is low. The other thing that is happening when an economy grows below what was expected structurally, yeah, is that, and this happened in Japan in the 90s up to today, is that the local players fight for market share. And if you're not the incumbent and you're big in that market, you're squeezed out. This is the reality. It's not only about how much money is in the pool. Yes, I understand the pool is bigger, but everybody was expecting more. So everybody's fighting for market share. You're not big, you're squeezed. And I think this is not too different from your survey. Yeah, I mean, which I've read with great care. The expectations of European companies have never been worse in the last 10 years. So this is what it is. On the question of total factor productivity, there's two things happening. Labor productivity is decelerating. Nothing wrong with that. Any country above $10,000 per capita tends to see a deceleration in the growth of labor productivity for a very simple reason. If I become more and more efficient, it comes to a point where it's harder to become more efficient because I'm already very efficient. Our labor productivity is lower because we're already at put it this way, the equilibrium. Or so China is getting there. There's nothing wrong with that. Total factor productivity is harder to explain because you're absolutely right that there's no doubt China is innovating and it's having an impact. And we see that in the value added of exports. Value added of exports is blooming in China. So you should see an increase in total factor productivity. But however, we economists don't know how total factor productivity works. It's not only about innovation. There's many other things happening that might be pushing down that total factor productivity. Imagine outright negative sentiment about the future, institutions, security, the focus on security. All of this could simply be, counter, like kind of mitigating that supposedly that increase in total factor productivity. So nobody's arguing China is not innovative, for God's sake. It is extremely innovative. And if anything, I keep on saying this is a concern for our SMEs. Because the fact that China becomes more innovative is great for China, no doubt about it. And I don't want to do zero-sum game here, but it's a competitive constraint for us unless we can become more innovative than China is. And what would be great is that innovation in China would create more business opportunities for us by China growing. That's not what we're seeing. So in a way, it's the worst of all worlds because China is becoming more innovative, but the market is not growing. So it's like, okay, more competition abroad, but less opportunities in China.
Just two words here, and Alicia and I are going to break this optimistic cycle for a little while, and then we'll get to it in a minute. The 5% mark, you have to believe that it is true, right? And we have very, very strong reasons to believe that the numbers have been revised systematically and one directionally to show and to get us to have a 5% reading at the end of the year. So everyone just to take that number with a pinch of salt, of course. We're not going to be in reality growing at 5% this year. That's fine. And it's okay. We're coming out of a very, very tough period. 2022 was a difficult year. But to take that at face value is complicated. The other issue with lower growth, as you said, it's still a bigger absolute value. But the other issue with lower growth is repaying debt. Because if you contracted debt thinking the economy was going to grow at 7%, then 6% interest rate is fine. If the economy all of a sudden goes down to 5%, and we are in a debt-driven economy, and we are in a state of over the indebtedness in China, then you run into problems. So from there on, you have to hope as an SME, you have to hope as an MNC that things don't veer into a systemic financial crisis in China, which, as you said, Alicia, of course, Chinese authorities have room and wiggle room to try and manage what's coming their way, both on the real estate side of things, property side of things, but also on the local government side of things. But as an SME, if you set that aside, the potential for a more systemic crisis, then that means you just need to be much more strategic than you used to be, right? At 10%, China's growth was lifting every single boat in the harbor, right? Everyone was benefiting from China's growth. At 5%, you need to be strategic, you need to be sector specific, you need to be segment specific, you need to have the right products, you need to have a good market fit, you need to be much more dedicated to a China strategy and a very market kind of leading market China strategy, so that you don't lose out on market shares, even in high growth markets. So just a quick addition there.
And for that, we have the EU SME Centre's market reports. As I learned yesterday from Liam, over 200 market reports on China available to download for free. With that commercial, I'd like to now move back to Fabrice. And you made a very good point about the 250% debt to GDP ratio. Japan much higher. EU and US not too far behind. But you were also very positive about China having an arsenal of assets and capacity for reform as well. So maybe you could elaborate a little bit further on what China would sell to pay off its debt, or what it would reform to stimulate more investment.
Complicated question. Is it working? It is? All right. Okay. Sorry for that. The consensus, I mean, the recommendation for the Chinese economy has been extremely boring for us economists for 10 years because it has not changed. It has been exactly the same. So for 10 years, we have advised, I mean, we collectively as a group, if you look at the reference or most authoritative point in that regard is the IMF reports on China. It's basically the idea that China needs to rebalance and develop consumption-based economy, alongside more market forces to steer away resources from government and state-connected enterprises toward more innovative part of the economy, especially SMEs. Okay, this is the baseline. This is the typical answer. The problem is China is doing kind of the exact opposite. And going back to the previous discussion on growth and TFP, actually 5% is quite impressive in 2023, given that China has decided that 30% of its economy will not grow, if not actually decrease. That is the real estate sector. It being capable of still delivering 5% of growth when you have 30% of your economy that is actually likely to have a recession, it is quite impressive. The problem is when you look at the drivers of that growth, it is not really reassuring. What you're seeing is that SOE are investing massively. You are seeing a lot of dynamic investment in infrastructure where China was already seemingly quite well equipped. So most likely misinvestment or suboptimal investment from a macroeconomic performance perspective. And that relates to the question of the total factor productivity. Total factor productivity, just to go back a tiny bit to the technicals, is a residual. So it's a black box. We calculate how much of growth comes from labor, how much of growth comes from capital, and what we cannot explain in the model is TFP, meaning that we have a number, but we don't have a clear causality on what causes it. And the problem is even greater when we emphasize that actually China is in some sector generating innovation. So you know the total number is flat. You know some sectors are generating innovation, meaning that somewhere there is a lot of efficiency loss. And that is most likely when you look at the direction of TFP, the decline has increased after 2013. And this is largely when you see a form of repoliticization of the economy and a more dynamic performance of large state-connected enterprises over SMEs. And hence, the conclusion that unfortunately it seems that Beijing is satisfied with the idea of sacrificing some growth in order to have some state-backed, state-favored actors to pursue political objectives. And that used to be largely social stabilization, and that is more and more becoming economic securitization related to the techno-innovative objective that the CCP, techno-innovative self-reliance objective that the CCP has developed over the past few years.
Yeah, I like that summary and analysis, again, leaving lots of room to go back to reform if they do want to stimulate growth. Again, sacrificing some of those political objectives would have to take place. We have 350 people online, so I think there's a chat box and people can type in their questions, and Liam here can help read them out. But I'd first like to thank all of the people that have come in person to join us here in the room, and maybe start with, I think it's Igor, right? Who has a question. So it's okay.
Hello, thank you very much for this thorough analysis. Very interesting. Okay, I'm coming from a business background, so I'm from the part of the not economist, management, industrial engineer. And I had always very much difficulties in explaining why, for example, in DigiGrow, there should be more industrial engineers and less economics guys, and more economic guys in DigiTrade rather than, so because it's more macro picture. So I have one thing, when you were talking, and I was getting there, I understand that negative, not that much growth, why should I invest there? And I understand that that's for the big finance, for the big companies. There's no me there. But here we are talking about EU SME Centre in China, and it's small, medium companies. And as you said, there are pockets of innovation. And I remember when I was doing my thesis in 2005, basically on a small Italian company, 50 people going to China. Nobody would say, you should go to China. What the hell are you doing in China? You go maybe to Slovakia if you want to produce low cost. Well, actually, they were there because innovation or something, big players were there. So actually to copy, to do what actually Chinese were doing, what we were accusing Chinese of doing, they were doing that to be able to sell here in Europe. So my first question is about this. What you can say about SMEs and not about big companies and the other one, and this is my eternal question. And your last slide, François, was about Japan and depicting that it was not that big. Since the 90s, basically, people were telling me there is this big thing. Oh, you don't want to get into Japanese scenario. Well, I think that 95% of the countries would like to be Japan, even 25 or 30 years down the road. Yes, there is stagnation. There is still stagnation, but there's, yeah, still okay.
Absolutely. You want to be Japanese, but I'm not sure you want to be in Japan, which is different if you're an SME. Because basically, just check the numbers. And what's the return on assets in Japan? 0.5? So what are you going to make out of it? What actually there's hardly any for direct investment in Japan, including European. So one thing is that you want to be Japan as a, and by the way, China will not have the income per capita of Japan. China will get older before it becomes rich. So it won't be Japan. It won't be Japan. It will be Japan growth-wise, but it won't be Japan wealth-wise. So secondly, what do you want if you're an SME? I'm not an SME, so I think I should be corrected by all of the 350 out there who probably are SMEs. But you're right. I don't need a big market, but I need an open market because, frankly, I'm not the first in the queue in terms of, power of negotiating power. Yeah. So I need an open market. I need an average return on assets which is positive because basically I'm not going to ride very differently from the rest. I'm not a market maker, so. China's return on assets today is below 2%. Growth is 5%. Return on assets is 2%. So, it's not a growth market. I'm sorry. Now, you may want to go to a no growth market. And there you go, you have a large market. Then next issue is who's going to go? because we have 55,000 people going to China this year only. So who's going to run it up? The third thing is who's going to advise you on basically national security issues, anti-espionage laws, and you name it. I mean, the chamber.
SME Centre.
But that's going to have to grow because compared to what it was before, it's getting pretty complex. So probably they'll be hiring. Where is the bulk of the employment? We just got the data, bulk of the employment in China now, the public sector. So you are the private sector, aren't you? So out of the private sector, which is already basically pretty squeezed in China, you are an SME of a foreign company. So yes, there are opportunities, but they're not the opportunities that were there in the 90s or even early 2000s, in my view. Sorry. So yes, not that I have nothing against the SME Center. Surely there's lots of things to do, but I think it's important for companies to know that this is not the China of the 90s. It's a different China. Maybe if you do one reason to be there, sorry, just to end on a positive note, innovation. Exactly what you said, meaning maybe you go to a growth economy, Indonesia, but you're not going to get the same like state-of-the-art innovation that you get in China. But you'd better be sure that you have access to that innovation and that getting the innovation doesn't go counter one of the 1,000 laws that I just mentioned. That's the key. If you are there to innovate, I think that's a great reason within the boundaries of the legal framework that China has built for foreign companies to make sure, to basically make sure that the diffusion of innovation is limited, to be frank. So that's it.
Yeah. I just wanted to add to your point because I want to make clear and sure that you got my point earlier. The bulk of foreign direct investment into China at the moment is really large companies because the Chinese market is so Alicia, you put it really well in terms of regulation, in terms of policies, in terms of market access, in terms of competition, first and foremost, to be honest. All of that means that larger companies are better fit for the market. That doesn't mean that there isn't opportunity for SMEs to help and support and follow through with their MNC partners, right? It doesn't mean that there isn't space for SMEs in certain niche areas where they have IP leadership, global IP leadership. But that just means that overall, when you look at the aggregate data, the overall behavior of companies on the market, larger companies are the ones that still think it's worth it. And you see a retreat of SMEs from the China market. We ran an analysis of Mittelstand German companies versus large German companies, and you see very clearly the different directions of BASF and BMW and Volkswagen who are doubling down, and I'll speak to that in a minute. And the Mittelstand companies who are not the small of the SMEs, right? They're the middle, if not slightly high of the SME range. Even they are, to a certain extent, withholding further investment. Once again, if they're in China, they're going to continue doing what they're doing. They're going to improve and they're going to maintain their production capacity. Of course, they're going to expand a little bit at the margin, but they're not in this very proactive, enthusiastic investment phase that we saw in the early 2010 that I was pointing to earlier, right? The 2010 wave of investment was an extremely positive, dynamic wave of investment. The Chinese market there, I want to go and catch it. When you look at where we are today, it's very, very different. Mentioning as well, so competition is a very big aspect, of course, and there's a very strong policy of industrial policy, of course, but also self-sufficiency, right? And so there's a lot of things that SMEs used to be able to provide in China that are being recreated and repurposed on the ground in China through Chinese competitors and through Chinese companies. And so the space is shrinking in terms of exports and the ability to export some of those components to China, and then the ability of SMEs to be in China and be those players there. There's a replacement happening there. Finally, think about the rise of geopolitics as well. We haven't spoken about this. It is crucial for SMEs. It is crucial for any company in China at the moment. If you're in the textile sector, you need to deal with the UFLPA. If you're in any sector that has environmental and high labor risk attached to them, you're going to soon need to be worrying about the EU supply chain due diligence regulation, right? this is so much harder for an SME than it is for a large company. And so large companies who can handle this, of course, will stay in China. Being in China is fantastic. Once you're there, producing in China is fantastic. But for the smaller ones that have to do and deal with regulation and policy and then geopolitics and all of this and the risk, and their boards asking them why they're going to China when they could go to Vietnam and they could go to the US and they could go elsewhere to go and catch that next stage of development, is just a harder case to make, right? And so it doesn't mean, once again, that there isn't opportunities to be had. It's just harder. And it is definitely harder, and we see it in the numbers. The numbers show that SMEs are retreating to a certain extent. Even for large companies, by the way, it's a defensive play rather than an offensive play compared to 10 years ago. It is creating a China hub, an in China for China position that is somewhat disconnected from the rest of the world, so that geopolitics don't go on the way, so that the large company aligns with China's objective of self-sufficiency, political objective of securitization, that the supply chain are kind of onshored. All of that is defensive, is a reproduction of things that exist outside in the world, but because of all of the policy environment, geopolitical tensions, you have to go and recreate it in China. It costs a lot of money, which is, but it's still more complicated for everyone in China at the moment, including SME. So I just wanted to make sure that that was going across.
But there's still opportunities. Okay, I want to move to the people online. I think we've got a couple of questions, and Leah, maybe you can do a quick summary of what those questions are, just so that we can capture as much as possible in the remaining few minutes we have. Then take this one.
We do have two questions from online speakers. I think it's short of all. Okay. Right, okay. But I believe all panelists has more or less already mentioned or covered on these two questions. The first one is there a case of intentional slowdown to transform the overall economy structure? And as are the indicators mentioned the second question is, what impact does the Regional Comprehensive Economic Partnership, RCEP, have? And do you expect investment flows between China and ASEAN countries to increase significantly?
Good question. We'll take RCEP. The lady from Hong Kong.
Maybe
I want to leave a little bit of space for François here, and of course, but maybe you can take the first question as well if you don't want to take ours, any of those. Just want to make sure you get an opportunity to chat, François. Go ahead.
Thanks a lot. No, just one thing to emphasize is that we should not overestimate the impact of RCEP. The trend of regional integration of the Chinese economy were already happening before RCEP. RCEP is definitely a good thing, but RCEP is what we in Europe would define as a first or second generation of trade agreement, meaning that it almost exclusively focuses on lowering tariff. Hardly, it touches a little bit on non-tariff barriers and regulatory cooperation, but this is largely secondary. There is a bit on rules of origin and customs cooperation that might be significant, but this is not this type of ambition that we Europeans deploy when we implement free trade agreements. And we might overestimate the impact of RCEP by just looking at the dynamic since the implementation and not differentiating that from the dynamic before the implementation that was already extremely rapid. And maybe one point to add on the question of the financial integration. Actually, I think is going to go down if you look at the overall financial dimension. And the reason I think why this might sound a bit counterintuitive to the general direction of the discussion is because we are mostly focusing, when we discuss economy, on the real economy. And from a real economy perspective, it will go up. You will see more FDI, more regional value chain. This is most likely to happen. But China will no longer have the financial capacity it had in the past decade to invest all over the world, because its current account, its trade surplus or its current account surplus is most likely to trend downward at one point, even though it had bounced back last year and in 2021. Hence, you will no longer see the massive outflow of Chinese financial capacity to support typically the Belt and Road, but also public spending or public debt in like-minded or like-minded partners of China.